Hello everyone, welcome to another edition of hashtag askrobco, special edition. We have our really good friend Marcus Dixon from Lonres with us today. Welcome back, Marcus, hope you're well.
Thanks, Rob, thanks for having me.
Great. So again, as I said, super excited to have Marcus back. It's been a few months since we last spoke, and I'm really interested to hear his view on where we are at the moment in the market and get some further intel and data from Marcus and the team at Lonres on what they're seeing on the ground. As every week, we've got James with us. How are you, James? All good?
Yeah, really good. Thanks, Rob. Good afternoon, everyone.
Great. So for those of you know the format, questions on the right hand side. If you write your question in the tab and we will answer the question, simple as that. I've just sent over the message to send over the questions, and Marcus and I will go through a range of subjects, everything to do with lending, pricing, modeling, product, sales, lettings, data, intel, stamp duty, premiums, all range of subjects, everything you want to hear about: home counties, prime, super prime, flats, houses, outdoor space, new build, HMOs, residential lettings, buy to lets, build to rent, all the subjects. Get your questions in and we will give you the answers. Before we get a quick update from Michael and a bit of an intro, Marcus, sorry, I'm just going to give you some intel that we share at the beginning of the show every week based on our own internal intel and some of the great information that we get given from Marcus and his team at Lonres. So if you open out the document on the right hand side, handout, and if you don't have that, I'll talk you through it. We are now going through week 42 of the calendar year with our data, and what we are seeing in week 42, which is highlighted at the bottom, is that the number of sales instructions, like I said, for the previous 3 or 4 weeks have now leveled off and are consistently in the mid 500s from the data set that we're looking at. And I think the key point that we're looking at as well every week is the sales numbers, the properties that have sold or exchanged going through. And this week saw the second highest amount of the year. That's the 207 that you see at the bottom of the sold column for week 42 of the data set. And that tells you a story within itself. The question we have been asking now, probably for the last 7 or 8 weeks, and maybe all the way back to when we previously had Marcus with us, the question was, did the market have legs? Was there sustainability in the sales volumes that we were seeing? Was the volumes of 2 months ago just the pent-up demand from lockdown and seeing through that supply, or was there sustainability? And as we can clearly see, the market is more than sustainable currently. It's behaving tremendously robustly, and if anything, more than robust. And the column on the right-hand side, just for the private banks and the upper tier markets that are on the call, even though the month hasn't finished and next week we'll give you the final figures, you can already see that the 2, 3, 5, 10 million plus transactional volumes are more or less matched up already, and we've still got the last week of data to go into that. So what you're going to see there in 2 to 3 to 5 to 10 million outperforming the last month and the previous months, as that market sees really strong activity and strong sales. So I think to go straight away to you, to Marcus, when we were here a few months ago, when you kindly joined us, and we were discussing this, I suppose, 6 to 8 weeks backlog, pent-up demand, post lockdown of transactions that were finding their way through to the market. Now, what is our viewpoint on the sustainability and legs, as we've seen such consistent volumes of property coming on stream, but more importantly, that property turning into sales?
Yeah, I mean, I think that what is quite interesting is that there was, a lot of talk, as you say, when I spoke to you guys last time about this pent up demand, and once that petered out, were we going to be in a situation where we were going to see far fewer sales? And interestingly, what we've seen is that yes, that pent up demand, has moved through the system, but we've seen a new group of buyers, arguably many of whom possibly weren't even thinking of moving in sort of March, April time, who have been bringing their properties to market and who want to buy something else, be that within London or maybe in the commuter belt or even further afield. But there certainly seems to be an increase in people bringing their homes to market to sell, and that's mainly domestic owner occupiers who are looking to trade what they have. So you're looking for more space, less space, something bigger outside London, something more central. So we've seen a real shift, and actually those people bringing their homes to the market have continued to do so all over the summer and now into the autumn. So for August and September, we saw almost a doubling in the amount of new stock coming onto the market across prime London compared with last year. And so far in October, taking it to, I think it was, I looked at this early on in the week, was about 60% higher than we saw in October last year. Partly, I think, because the seasonality has been thrown off a bit this year because of the sort of enforced lockdown that we had in terms of the property market. But I think, more than that, there's a lot of people who are looking for real sort of long-term lifestyle moves at the moment, who seem to be coming into the market, who I wouldn't consider in that kind of group that we were thinking of as that sort of pent-up demand from the spring.
So if we're going to look into a bit more detail into that new group of buyer, can we break that down further into maybe how it affects possibly the rental market? So investor stroke end user stroke second home end user, and then what are the repercussions from that activity and that behavior directly again to the rental market in terms of the volume of stock and the uptake of that stock and the void periods, and how is that affecting our buy-to-let investor, landlord, commercial owner, and what is the negative impact, if there is one, on that space compared to the buoyancy and robustness of the home ownership stroke buyer market?
Well, I think, interestingly, what's happening within the rental market is sort of outside of central London. The rental market is pretty buoyant. A lot of people are moving around, and people are taking the opportunity, possibly if they don't need to be in central London for work at the moment, they're renting something further out, and so the rental market outside of London seems to be pretty buoyant at the moment. It's a little bit more challenged in central London. There's quite a lot of stock, so we're in a situation where stock levels are around 75% up on where we were a year ago. So there's a lot more on the market, and we're seeing a pretty steady supply of new stock coming onto the market as well. So there's fewer prospective tenants. There's quite a lot of stock, and new instructions are sort of continuing apace, which means that for tenants, they are seeing themselves as being in a pretty strong position, and they are negotiating on rent. So we're seeing average discounts off initial asking rents of sort of about 9 or 10% now. And to give you an idea, sort of in a sort of normal market, we'd be looking at sort of 3 or 4%. So they're much bigger discounts, which means that we've seen achieved rents fall by around 10% compared with last year. And landlords who want to limit their voids are having to accept lower rents. So we are, we're it's a it is a slightly difficult situation for some landlords. We are seeing some who are looking to sell into, particularly if they've got something that appeals to the sales market at the moment. So we are seeing some sell up, but I think there's quite a lot who are taking a longer term view, who are thinking actually if this if some of this rental stock is sold up, then we'll be in a situation hopefully once we're clear of COVID, or we have a vaccine, or wherever we move to, that the demand will be there again, and actually the level of stock will be relatively low. So I think those who are taking a sort of medium to long term view are sort of hanging on in there and thinking actually this might be a good thing for me long term in terms of my rents. But at the moment, I think it is a challenge, and particularly for people who rely on certain types of tenants. So, for example, if you're in maybe South Kensington and you're relying on the overseas students university market, is a difficult one at the moment. Whereas actually, if you've got a sort of a family house or a flat with a garden near a park somewhere in southwest London, actually you're probably having a much better time. And I think that we looked at sort of southwest London rental volumes are sort of within 5% of where we were last year, but South Kent's about 40% down. So it really depends where you are.
Brilliant. James, you want to add anything on that?
Yeah, I just wanted to add in terms of the lifestyle movers, which largely has come on the back of more flexible working. Has the tenant demand, have their needs changed at all? Their needs of home working space as well as sort of outside space?
Yeah, I mean, I think that it's actually the needs of the tenant have become much more closely aligned to the needs of the owner-occupier, following the lockdown. And actually, a lot of people who were renting in central London actually weren't spending a huge amount of time in their rental property. So actually, something that was in a really convenient location, but maybe was a little small for them, or didn't have a garden or balcony or view, was fine if you were at work every day and then out for dinner every evening. If that's not the case, and suddenly you're working from home, and what they're looking for is something with a bit more space, possibly separate, an extra bedroom to use as a separate office, and the need to be quite so central just isn't there at the moment. So it's the sort of larger stuff that's a little bit further out is more appealing to them. I mean, the other option is that they decide actually, my employer might not need me in the office very much for the next 6 months. Do I go and rent in the Cotswolds for 6 months, and then suddenly when I get the call and I have to come back to the office, do I head back to London and rent something there? So there's quite a lot of sort of difference in terms of what people are looking for, and I suppose the slight casualty of that has been the small flat in a very central location, which at the moment people are maybe thinking, well, I don't need to pay those rents to be so central, and looking for something else.
Yeah. I mean, those buyers which want a pied-à-terre, or those people that might rent a pied-à-terre, have been somewhat, the need for that has diminished. I mean, it used to be quite a strong attribute to have a flat that was very much a lock up and leave, and something that you'd sort of really spend very limited time there. I think that, as you say, that market has somewhat shrunk in terms of its uses. Just going back to Rob for some further questions.
Yeah, I mean, we touched on pre-call, and it's something that some of the lenders have on this show have approached us about, in terms of struggling to get valuations, conveyancing, mortgage approvals, because of the unprecedented volumes that we're seeing, and the possible race against time with the stamp duty window. How are you seeing that impact? We discussed last week that the average deal is taking longer to progress because of the unprecedented volumes in the supply chain that's required in all of those areas to allow a transaction to go through. So it's great that there's double the amount, more or less, of transactions taking place. There's double the amount of mortgage applications taking place, which goes through to conveyancing and valuations. At the same time, it's all getting bottlenecked, so it's delaying the surge in final transactions because the supply chain can't deal with the volume.
Yeah, and we are definitely seeing that in terms of the length of time from when a property is put under offer to when it exchanges. I mean, it increased quite significantly over lockdown for obvious reasons, and since then it's been relatively high. So we've been looking at sort of an average of somewhere like 2.5 months, and actually quite a lot of properties, particularly ones where people need higher loan to value mortgages, flats as well. We've seen some quite aggressive valuations on some flats which are holding things up. Interestingly, I suppose for prime, and possibly one of the reasons why we've seen the top end of the market so buoyant is actually the amount of cash deals at that level, and so they are putting pressure and probably paying handsomely for their conveyancing solicitors to move things forward, and also they are buying with cash or with significant deposits. So actually they're almost self de-risking it for the banks, and so they can move through more quickly. And hopefully, for prime, it stands in pretty good stead in terms of the risk on a lot of prime loans is relatively low because of the levels of equity that are involved in these deals. That you would hope that it means that some of these deals, where possibly if loan to values were higher, they would be held up longer, might go through. But I think there is definitely a risk, and I know they're talking about this in the mainstream markets, of people who are worried about getting the deal through before the end of March for the stamp duty cut off. And that obviously will have an impact, particularly at the lower end of the prime market. At the upper end of the prime market, to be honest with you, if you're buying at 5 million, a £15,000 stamp duty saving isn't really going to be the be all and end all of the transaction. And the likelihood is, if they're going to do anything, the buyer and seller will probably just share the pain a little bit. But there's definitely going to be people aiming for that date. And so I think it's going to be a pretty busy sort of, certainly latter part of 2020 and first quarter of 2021 for any conveyancing firm, I think, at the moment, as well as valuers, because there's so much going on outside of London and in London. I mean, arguably more actually outside of London. I mean, some of the figures seem to show that under offers are up sort of 50-odd% across the country. So there's going to be a lot of very busy conveyancers. Whether the government actually steps in sort of February time and maybe extends, you maybe have to get to a certain stage by the end of March and then it extends it for a period, I don't know. But there seems to be a lot of press at the moment about this cliff edge for stamp duty, and everyone's sort of scurrying around trying to get in before it.
I mean, I suppose that's the latter part of one of the previous questions was, where do you see the market in 2021? Does it have any legs, and what happens pre that date and post that date?
Yeah, I mean, I think that realistically, I think we're going to see prices hold up in the first quarter of 2021, because actually those deals, as we're saying, particularly with these sort of long lead times for getting properties bought, we're talking about actually deals which are being agreed now, and the market's pretty buoyant. People are pretty confident that the prices are slightly up on where we were a year ago now. So I don't see that changing over the next sort of 5 to 6 months, unless something sort of catastrophic happens, which we can't foresee. I think probably the second half of 2021 is the real big unknown, and it's going to be the challenge. Possibly less so for prime, because as I was saying, this sort of stamp duty incentive isn't quite such a significant part of the whole cost and of the purchase. So we could see actually it being less impacted on prime. I think the real tell really will be the impact on the sort of domestic and global economy in the second half of next year, with COVID and Brexit. and actually whether that will start to feed through. Interestingly, actually, there could be a bit of a currency play, and I think we did touch on this last time. You know, if the sort of the money markets are a little uncertain about, you know, Brexit and what it means for the UK economy, and sterling weakens, we could see overseas buyers swooping in next year to buy, you know, with a weak sterling. So actually, it could be, you know, a lot of people are talking about falls potentially if, you know, if a few things align, we could be seeing a relatively busy market in prime in the latter part of next year.
So when we go through the data and historical trends, we saw probably in the last 5 years that infamous March 16 with the rental surcharge, and the transactional volume that was seen in that month was a record month for the last 5 years of data that we've been reviewing and the market has seen. Do you feel that there could be a repeat this year or 2021 March if there is no extension to the stamp duty holiday?
Definitely. I mean, I think that the signs suggest that everyone is racing towards that date, not just in London but elsewhere. And also, you do have, again, similarly, there's the new rates for overseas buyers that come in April as well. As I say, I think that, you know, with those, if there's more of a currency play, actually, it can cancel out any additional costs. So people might wait and just sort of slightly gamble on the fact that, you know, they might get a better deal through the currency and pay a little bit more on the tax. But I think it's definitely going to mean that we're going to see deals which we would normally in a normal market see happen in sort of April, May, June, be pushed into February and March. So I'm expecting a similar kind of significant rise and then a pretty big fall as everyone kind of, you know, reassesses post the end of March. So I think we are probably going to see that again, which is obviously a complete nightmare for someone who deals in sort of stats and things like that, because you've got to explain away for the next 3 years as to why there was this sort of huge rise and fall, and why, you know, the following year that the fact that the markets dropped massively and then increased is nothing to be worried about. But yeah, I mean, I think it's a pretty sure thing that that's going to happen.
James, what else you got for us?
Well, next year, I think, for just going at the reverse end of the market for first-time buyers, the government's obviously announced sort of relatively hot off the press incentives for first-time buyers with the 95% loan-to-value mortgage, and there's a new sort of generation buy for generation rents. How do you think that will impact the market? And do you think on the back of that any sort of stamp duty changes will result?
Well, I mean, I think that what is very clear is that they want to try and overcome the significant hurdle for first-time buyers, which is the deposit. And I think that, you know, the new 95% mortgage, you know, appears to just, you know, offer a sort of a way that first-time buyers can get onto the market. To be honest with you, it's kind of a similar version. It's a new version of Help to Buy in quite a few. In quite a lot of respects, with the government effectively de-risking the loan for the bank. I think that the difficulty is the timing, possibly, because we're in a situation where banks are becoming more and more cautious about, you know, high loan to value lending, and also lending to people whose jobs might be a little bit more precarious and who might be more at risk of unemployment. And, you know, unfortunately, it seems to me that, you know, what's happened so far is the people who've been most impacted by job losses and furlough and things like that are the people who are earlier on in their career, who are possibly the sort of people who will be first-time buyers. So I think it's, you know, obviously they want to try and get as many people onto the ladder as possible. I think the big question is how keen the banks are going to be to lend to some of these first-time buyers, even with this government guarantee. So I think, you know, it could still be difficult for them. and I certainly don't expect to see, you know, a really significant shift of people from renting to buying, certainly within the next 12 months, just because of the uncertainty of the economy and the way that you know, a lot of the lenders are reacting. I mean, that, you know, there was, I think it was Nationwide, I can't remember who it was, who, you know, are no longer accepting certain types of deposits that come from Bank of Mum and Dad. And, you know, it's sort of actually, a lot of these people, even the ones who are buying with government buying schemes, have Bank of Mum and Dad money. And if that starts to become an issue, then potentially we could be in a situation where, you know, you know, as much as the government wants to encourage these people onto the housing ladder, the banks might be a little bit more cautious. Yeah,
I mean, you know, we could be returning, if something like that does come into play, we could be returning to the mid to late 80s scenario of Margaret Thatcher's policy of enticing home ownership that created the boom in the late 80s, which is where I entered the market at the back end of that, where, you know, 50, 60, 70% of the country was in negative equity because everything fell off a cliff. But for a period of quite a few years, with that incentive, the housing market did explode. Another point that you raised, Marcus, is the banks are now starting to be a bit more focused on the type of lending that they want. We discussed in previous weeks, where we've done pricing and product, about rates going up slightly, especially where deposits are smaller. So you're seeing 0.2, 0.3, 0.2, 0.3 increases in certain priced products, and that's changing by the week. Why? Because there's so much demand and they can't get through the volume. So for the reasons we mentioned earlier, it makes sense for them to raise pricing because they're inundated anyway because of the unprecedented conditions. And I suppose that all comes back to the fact that, you know, we currently have great availability and are getting into the properties and doing really good turnarounds on what we provide, but the mass factory market just can't cope with the volumes, which in turn is putting pricing under pressure, which is allowing pricing to rise, and it has a complete knock-on effect. So everything that you're raising is all connected, and it breaks down to every variable within the industry and the sector, from lending to risk to sanction to mortgage levels to deposits to borrowing to timelines and so on. I mean, it's a fascinating place that we find ourselves within the market at this moment in time.
Oh, I agree, and I think, you know, what's really interesting as well is that, you know, historically, you know, your house has been part of your overall spend. So, you know, you've had your holiday budget and your car budget and your house budget and all these sort of things. And actually, I think what's become quite interesting at the moment is that, you know, people are struggling to spend their holiday. You know, if you're fortunate enough not to have been hit financially by the pandemic, actually you potentially have more money in your pocket at the moment because of, you know, your holiday budget's gone. Do you need the second car? All of that sort of stuff. You know, you're not commuting, and so it's, you know, for a certain group of people, actually they probably have more money to put towards their housing. So, you know, lending at a certain level, you know, you could argue that, you know, a prime falls into this bracket, that if banks are overrun, you know, the people that they're going to want to lend to are these people with sort of relatively big budgets and quite a lot of disposable income, which suits the sort of the prime London and prime sort of commuter market possibly a lot better than it does the first time buyer market. So actually you could almost start to see a sort of a two-tier system where actually it's a lot quicker to get lending on a £1 million house at, you know, 50% loan to value than it is on a £200,000 flat.
Agreed. James, what else have we got? Last 10 minutes. Keep your questions coming through, everyone.
Yeah, sure. So last week, obviously, Knight Frank published some research about the super prime sales market here in London of 10 million plus, which was, I know some of the Lonres data fed into that. It was just whether you had any more information or insight you could give us just from an instruction perspective on that super prime market. Has 2020 seen an influx of available stock, or have these been off-market transactions, or what's really built that momentum?
I mean, we've certainly been seeing an increase in stock across the board. So coming onto the market, so at the very top end of the market, 10 million plus, and also sort of right across. Interestingly, there is a higher proportion of that sort of super prime market, which is off market. So it's kept in agents' bottom drawers, or we have a section on the site actually where you can agents can list properties without revealing all of the details about that particular property, so that they can sort of market it without giving away information. And obviously, people who own these properties are often in a situation where they don't necessarily want it publicised that that's their house and photos splashed across the press of that particular property. So I think but we've certainly seen an increased activity. I mean, if I was just looking at the October figures, so far in October, the number of sales at 5 million plus are up 78% on where we were last year. So that top end of the market does seem busy. Interestingly, it's a market that traditionally had a relatively high proportion of overseas buyers. You tend to find in central London, the higher you go up the sort of the price ladder, the higher proportion of overseas buyers. But actually, quite a few of those buyers have been UK-based domestic buyers. Not saying they may originally have been from overseas, but they are people who are living here. And I think it's similar to what's happening across the country, and it's this sort of lifestyle move. And someone's thinking, actually, for the next 10 to 15 years, I want that big family house in London. And actually are looking and are spending that kind of money to get it. So that market is it seems to be particularly busy, and as certainly busier than the market kind of sub 2 million, which is still a little bit down on where we were last year.
Yeah, and obviously with the sort of influx of purchases this year, those purchases would have been subject to quite a high stamp duty, despite the stamp duty holiday of the first 500,000. With the way buyers are operating now in sort of almost like a 5-year cycle to a house, do you think the next year or two could be more subdued in that sort of super prime market, or do you think momentum will build on from this and continue?
I think potentially. I think that it will be interesting to see what happens when overseas buyers can return to London, because interestingly, the top end of the market has been pretty buoyant, without actually quite a few of their core purchasers being able to come over to the UK and access that market. So I think if they're allowed to come into London next year, then possibly we could see the momentum continue at the top end, because obviously there'll be we talked about pent up demand from the lockdown. We could be seeing a year's worth of pent up overseas buyer demand come back into the market. So actually, I'm pretty confident. Interestingly, as well, with that end of the market, it's the people who are tending to own properties at that level. It's part of a much larger portfolio. So whilst they might be listing the property for sale, it's not likely that they'll sell it for an absolute bargain price. And if they put it on the market and they don't achieve what they want for it, they'll either just leave it on or they will withdraw it. So actually, you're in a situation where I don't think we're going to see any real price falls, unless there's sort of a big economic shock next year. And potentially we could see it busier, as I say, because of the overseas buyer demand. It's always a rarefied market, and it's one of those ones that sometimes if you look at the figures over a couple of months and it looks like there's been a real drop, it can be down to the fact that 5 buyers who were going to buy didn't, or or bought in New York or bought somewhere else. So it's the figures are always a little bit erratic, but actually it's been a pretty good long-term trend in terms of that market being much busier, and I'd hope that will continue certainly into the early part of next year, but even into the later part of it.
Yeah, thank you for that.
You mentioned something, Marcus, that we track quite a lot and we've got a huge exposure to, and that's off-market transactions, especially prime, super prime. And we obviously, it's one of our specialisms, so we're very narrow, very deep market experts, leaders in that space. It was interesting to hear you raise it. I just wondered how you see the trends on that information when it's a little bit off the surface. It's not so transparent. Sometimes there's premiums, or the sale might include certain things. So what are you seeing on that in more detail than what you've mentioned?
I mean, it's always a slightly difficult one with off market, because these properties are listed off market for a reason, and so we always have to sort of tread this very fine line between asking for as much information as we possibly can without making the person feel like you're asking for too much and them not giving you anything at all. So the way that we tend to do it is, we'll ask them to give us certain things, certain elements of property. So for example, it's a house in Chelsea, we're asking somewhere around 15 million for it, and it's got sort of roughly 6 bedrooms, and that's probably about it, and ring us for more information. What we tend to ask is, once that property transacts, is if we can have some more information about it, even if it goes onto the website as invisible. We don't always get it, and I think it's a nice one if we do. We get a lot more than some of the other sites, but it is a quite tricky one. I would say that we probably get more now than we used to, partly because of the sort of additional costs of holding properties offshore and within company vehicles and that sort of thing. In that, there was a lot more properties that were held in those kind of structures previously, because there wasn't really any cost in doing so. Now there is a cost. It's you're making a conscious decision to pay a certain amount of money every year to remain anonymous or to trade that property within a company, and less people are doing that. So we do get a little bit more of it. It's always a really difficult one, because that sort of rarefied top end is such a sort of a secretive market, and you'll know this, Rob, as well as I do, in that you want as much information as you can, particularly because they're big ticket glamorous deals that everyone wants to know every single detail about, but it's often they don't sort of want to give the information, but we do our best in terms of getting as much information as we can, even if we just know this particular house traded for around this amount of money around this date, is often sort of the best we can get.
I mean, we didn't expect to be where we are now heading into November 2020, and we didn't expect the prices would have risen by 1%, 2%, 3%, depending on where you're looking. And we wouldn't have expected that there would be possibly bidding wars and premiums paid. And tell us what you're seeing there. So let's say on the on-market stuff where people are outbidding each other to get a property, what's your view on that, and what are you seeing in that area?
Well, I think it appears that that's got a lot to do with the fact that people are making significant. A lot of the activity that's going on at the moment is to do with lifestyle, and actually, when you're talking about moving for lifestyle, and that might be a complete change of lifestyle, or we want a bigger kitchen and a roof terrace. It's not all everyone's selling up and buying a farm in the Outer Hebrides. There's a sort of an array of sort of reasons why, but those lifestyle moves are very property driven, and I think that when you're making that sort of move and you find a property that is ideal for your requirements, the emotions kick in, and actually people who are bidding on these properties are doing so because they really, really want that house. And I think that we're seeing more of that. There's been a real trend over the past sort of certainly 10 years, but probably sort of 15, 20 years of properties in central London being a commodity or an asset, and are treated a little bit like that, and it's all about investment value. I think it's certainly for owner occupiers at the moment, a lot of it is about this. We will hope this is a very good investment for us, but actually it's about somewhere that we'll be really happy to be for the next 5 years or so. And in that case, people are bidding possibly slightly more than properties are worth, because actually to them it is worth that amount of money. It's obviously an absolute nightmare for valuers and lenders, because you've got to justify those, that emotional decision in terms of pounds and pence. But we're certainly seeing that. I mean, I would say it's still a very small proportion of the market. So I ran some numbers a couple of weeks ago on the number of properties that were going for over their asking price, and it's still only around sort of 10-11% of the market at any one time. The majority is going for less, and in some cases far less than people are asking, because there are some quite optimistic vendors as well at the moment. I think people think if you've got a house with a garden that you can almost put any price on it, but it is happening, and there's a lot of sort of emotional house buying going on at the moment.
If I'd said to you on the 1st of April of this year, in the deepest, darkest moments of full and complete lockdown, that in October you're going to see 10% of transactions, people overbidding above market price, what would you have said to me?
I would have said that you were being very optimistic, rather. I think no. I mean, what's happening now. I mean, we are in a situation that we've never been in before, and in April, I think we were all sort of looking at each other, thinking, where do we go from here? What's going to happen? I sort of optimistically hope that Prime London's pretty resilient, and it's been resilient in the past, and it will be again. But there was certainly a big part of me that was thinking, gosh, where do we go from here? And I think we've been pretty surprised about how robust the market has been, and certainly about the level of activity. I mean, normally in prime, when there's sort of economic uncertainty, when people don't know what's going on with things like Brexit, the natural reaction is to pull back, to sit back, to not move, to stay in, to hold on to your property, and transaction volumes, new instructions drop back, and actually we've seen the opposite of that. It's a really interesting phenomenon, and actually it shows the importance of where you live. And I think that actually, we maybe had slightly forgotten about the importance of, your house is ultimately somewhere that you live, and that's become very, very important when we've been told that we've got to stay in our house for prolonged periods of time. So it's certainly taken me by surprise, and it's a good thing for our market, and particularly anyone who's working in property or anything associated with property, because I think that there's a lot of industries that are having a pretty tough time at the moment, and I think hopefully the people in property, even if next year is a bit of a challenge, will have been busy enough and will have been able to do enough deals this year to kind of carry us through.
Brilliant. Marcus, you have been great as always. Please do come back in a few months, because
that'd be great.
The market is moving in a way that is so unprecedented, so uncharted, could we say, because of everything that's happening in the wider economy. And what we're living through now within an industry is so unprecedented that the intel, the data, the knowledge, the experience, what we're seeing on a daily basis, which is everything that #AskRobco is about, is made for the volatility and the uncertainty of the times that we live in, which makes talking to you and this edition so special. So thank you so much for your time and your insight. Really great to have you, Marcus. Thanks once again, James. Thank you everyone for turning up week after week after week. Thank you to everyone watching on YouTube or through all the other platforms that we're on, and sharing it with your risk, sales, credit, sanction teams. And we will see you again, same time, same place next week. Hashtag askrobco, 1 p.m. every Wednesday. Thanks, Marcus. Thanks, James. Have a good week.
Thanks. That was fantastic.
Stay healthy and take care, everyone.
Thanks, everyone.